We'll just come on to the second part then of these videos on monetary policy. This is just for higher level students and sort of supplements the information that you received on monetary policy previously and in the other video. So it covers sort of perhaps three additional sort of items, one of which is this relates to this diagram here. It's called the credit creation process. We need to start to understand really how money is created in any economy. And the process of creating money by commercial banks is really important. The majority of money in any economy is invisible money, it's bank account money. Like it's not printed money, it's not notes and coins. People have got money in their bank accounts and they trust the banks and they trust the process by which they can access this money. But by depositing money with banks, it actually leads to the creation of more money. The money supply goes up. This diagram tries to explain it, and if you have a look here, we start with this guy who's got £10,000 to deposit with his bank. So he puts it into his bank, and obviously at any point in time, he can go to his bank and take out the £10,000 that he's got deposited with him. It's his money. The bank just doesn't want to sit on that money, though. The banks don't make money by just putting our money, our deposits into their bank vaults. They make money by lending out money. So they will choose to lend out some of this money. We've put a cash reserve of 20% here. We're basically saying this bank will keep cash, 20% of any deposits, and it will lend out the rest. So it will keep cash of 2,000 and lend out £8,000 to this guy who wants to buy a tractor. And he buys it from Agrico Limited for £8,000, and Agrico deposit that 8,000 into their bank. So what you can see happening now is that initial deposit of 10,000 has created additional money of 8,000, because at this moment in time, this guy can still go to his bank and take out his 10,000, and Agrico can go to their bank and take out. He takes out his 10,000. Agrico go to their bank and can take out their 8,000. There's £18,000 worth of money now in the system that started with just an initial deposit of 10,000. Obviously, the process doesn't stop there. This bank will keep 20%, £1,600 as cash in the cash reserve, and they'll lend out the rest to this guy who wants to buy a car. He buys the car for £6,400 from this guy with a briefcase who deposits the money into his bank. And we've created an extra £6,400 in money. So all these three people, this guy, Agrico, this guy with a briefcase, all now have access to money, £10,000, £8,000, £6,400, and on and on and on. Like more and more money has been created. It's called the credit creation process. It's quite important because, obviously, the decisions that these people make as whether they want to borrow the money to buy a tractor or a car are dependent upon the state of the economy and interest rates, and therefore the central bank does have some influence over whether or not this guy will buy a car now. If they put interest rates up, he might be discouraged from doing it, and so he postpones that purchase of the car, and that slows down demand in the economy and slows down the growth of money supply, which is what the government intend to do. So we can summarize this is all, we use this diagram of the money market, the market for money, or the determination of interest rates. Interest rates are simply the price of money, or the cost of borrowing money, or the return on lending money. And we can look at the demand for money, the supply of money. Here, the rate of interest is the price of money. Right? So we don't put price, we put rate of interest, quantity of money on the bottom. Demand for money is like a normal demand curve. Supply of money is thought to be fixed at any one moment in time. But the interaction of the two leads to an equilibrium rate of interest at that point there. So what that means is that the money supply and interest rates can be altered by the central bank in order to meet their monetary policy needs. And it doesn't matter which way around they do it. The central bank could focus on increasing or decreasing the money supply and having the impact on interest rates, or it could change interest rates, which will in turn impact on the money supply. Right? So here in red, I've talked about the increase in the money supply. The government increases the money supply. central bank increases, I will show you how in a moment, leads to a decrease in interest rates from here down to here, so that decreases, which leads to an increase in aggregate demand, increase in spending, or they just decrease interest rates to begin with, which will in turn shift the money supply, which will have the same impact of increase in aggregate demand, right? And the reverse is shown in this diagram with the money supply decreasing or interest rates increasing, and it will be a contractionary monetary policy. So how do they do it? Well, these are the various tools of monetary policy. There's four. The first is called open market operations. This is where the government or the central bank will buy and sell government bonds. You're probably aware governments borrow huge amounts of money, and they issue what are called bonds or securities to do so. It's just an IOU, piece of paper. You buy it off the government and they promise to pay you the money back with interest. So if the government wishes to decrease the money supply, it sells these bonds. It sells more. It borrows more, essentially. Because when we buy those bonds from the government, it takes money out of the system. We no longer spend that money on cars and houses because we've lent it to the government. If it wishes to increase the money supply, it just buys these bonds back. So it says to us, "Look, do you want to buy? I'll pay you back now for this bond," and it gives you the money, and probably you'll spend some of it. You could change the reserve requirements, so that's going back to this diagram here, where we said the bank keeps 20% in reserve. The government can control that, or the central bank can basically dictate to the commercial banks, "Look, you don't keep 20% in reserve, we're going to insist that you keep 30% in reserve." And again, that will slow down the money supply. It will slow down the amount of money the banks have got to lend. Well, they could do the reverse and say to the banks, "Look, you can keep less in reserve and lend out more, and that will speed up the economy." Changing interest rates, as I said, that's the main one. It's a really important influence on the economy, as we saw in the other video. And then this thing, relatively newish term that we've come across in the last few years, quantitative easing, very similar to open market operations, but not just involved with government bonds. Basically, the government, the central bank, can buy and sell assets belonging to commercial banks in order to sort of increase the money supply. So if they wanted to increase the money supply, they would buy assets belonging to commercial banks and essentially giving the commercial banks more liquidity, more money in which they can lend it and promote that monetary expansion in the economy. And that's quantitative easing. Okay.